So in this section, we will cover equity valuation. The first topic we will cover is why it is that we can use the present value formulas to value equity in the first place. We are going to be valuing equity based on its dividend payments. This is a counterintuitive notion these days, as many stocks don't pay dividends. So I'll explain why our present value formulas are still useful in this setting. In the next topic, we will use our infinite horizon formulas developed in the present value section. So these are the formulas for the perpetuity, the growing perpetuity, and the delayed perpetuity. These are very useful for valuing equity. One of the inputs into these formulas is the growth rate of dividends. So our last topic will be, where does this growth rate of dividends come from? We will see that we can break the growth rate of dividends into the amount reinvested and the productivity of the firm. That has some really striking conclusions in terms of what a firm should invest and when it should disinvest. For instance, we will see that not all growth is created equal. Sometimes growing a company can actually destroy value. Now we're going to apply the same to stocks. So what is equity? Equity is the residual claim on the assets of the corporation. So equity is what is left over after the bondholders have been repaid. So if you own equity in a company, you are a partial owner of that company. Another word for equity is common stock. So the return to equity comes in two forms. One is a dividend and the other is the capital gain. So equity holders receive dividends and capital gains. So what is my return if I hold shares in a stock? Well, of course, we're going to use the definition of holding period return, same definition as we used before. My value 1 year from now minus the value today divided by the value today. Percent change in the value of my investment. So what's my value 1 year from now? Well, it's the price per share 1 year from now. Price per share 1 year from now, plus the dividend per share 1 year from now. We always calculate prices after the dividend has been paid. It's called the ex-dividend price. Now we subtract out what we paid, which was the price at 0, and divide by what we paid, which is the price at 0. So this is the holding period return, and we can manipulate it a bit to read something like this. So this first term here is the percent capital gain. So it's the change in price divided by previous price. And this guy right here, it's the dividend yield. So let's just use the notation R for holding period return. So then, note, we have R, we just wrote, equals D1 plus P1 minus P0 over P0. If we do a little bit of algebra, that tells us that 1 plus R equals D1 plus P1 over P0. A little more algebra will get us to P0 equals D1 plus P1 over 1 plus R. So this is our first valuation formula for a stock. It says, what's the price of the stock today? Well, it's the discounted value of our cash flow tomorrow, which is the dividend, plus tomorrow's price, or rather, next year's dividend plus next year's price. That's maybe kind of interesting, but not super helpful because who knows what next year's price is? Well, after all, we can use the same method to tell us what next year's price is. After all, P1 should be, by the same reasoning, D2 plus P2. So the dividend 2 years from now plus the price 2 years from now, discounted back. Okay, so substituting that in, we get P0 equals D1 over 1 plus R plus D2 over 1 plus R squared plus P2 over 1 plus R squared. Well, now we're basically in the same boat because we have a present value formula, but it's still got the price in it, the price 2 years from now. So what do? Well, if we continue to apply the same reasoning, you can see what we're going to get. P0 is the dividend 1 year from now, plus the dividend 2 years from now, plus the dividend 3 years from now, and so on and so forth, until we feel like stopping when we get the dividend T years from now, and then we get this terminal price T years from now. Now, we can keep going and going, and as long as the price grows more slowly than this discount factor can shrink it, as long as that's the case, we can keep going and get what's called an infinite horizon formula. The price is the present discounted value of the future dividends out to infinity. And that is the basis for how we value equity. We value it just like we value anything else, namely based on its cash flows. And what are the cash flows? They're the dividends, or really any cash flow that you get. Sometimes it may not be called a dividend. For example, if the company is taken over and investors are bought out with cash, that's essentially a dividend. Any cash payment coming to investors, that's one of these Ds. Now you might say, wait a minute, a lot of companies don't pay dividends, but their value is not zero. So can we maybe just not believe these formulas? Well, the answer is that just because they don't pay dividends now doesn't mean that they will never, ever pay dividends. So perhaps the dividend is coming sometime in the future. So whenever we think those cash flows are going to be, we put them in our present value formula. These dividends could be zero for quite some time and then become non-zero. So how do we determine these future dividends? The way we do it is we build a model. And the most basic model we can build is a model where the dividends grow at a constant rate over time. So this model is the most famous model for pricing equity. So D1 Now, we don't know what dividends are going to be for sure. So this is actually the expected dividend next year. D2, we're just going to assume that D2 is equal to D1 times 1 plus G, G for growth rate. Well, nothing too complicated there, but the important thing is that D3 is also D2 times the growth rate, and D4 is D3 times the growth rate, and so on and so forth. So we see that D3 is really D1 times 1 plus G squared, and D4 is really D1 times 1 plus G cubed. So if we think about the cash flows on this equity, we get D1 over 1 plus R plus D1 times 1 plus G over 1 plus R squared plus D1 over 1 plus G squared over 1 plus R cubed, and so forth and so on. And we already know what the formula is. It's the formula for the growing perpetuity. This works as long as R is greater than the growth rate of dividends. We'll do a quick example. So assume the dividends per share are expected to be $3 next year, after which they will grow at a growth rate of 10%, and the discount rate is 15%. The price is D1 over R minus G, or 3 over 0.15 minus 0.10, or $60. That's the price per share if $3 is the dividend per share. So you might say that this formula is not good for all companies because some companies, for instance, might not pay dividends right now and might pay dividends in the future. Well, that's true. And for that, you can use our formula for the delayed perpetuity. So you may recall that from the present value clip. You might say, well, maybe they grow quickly at first and then slowly in the future. Well, the present value formulas can accommodate that too. You have a phase for fast growth and then a terminal phase for slow growth. I'm not going to work out the details here. You can see them in the notes. But the important thing to know is that we're just applying the principle of present value. Where does dividend growth come from? Well, dividends come from earnings, which in turn come from the firm's profitability. Earnings in a firm have to equal dividends plus retained earnings, by definition. So we are going to use the terminology, the plowback ratio, to denote the proportion of earnings plowed back into the company. The plowback ratio is going to be denoted B. So B, that's our plowback ratio, is retained earnings divided by total earnings. So if we use the notation E for earnings per share, then our earnings are equal to our dividends plus our retained earnings, or B times E. So D here is the dividend. B times E, this is retained earnings. And rearranging, D is 1 minus B times E. So those are all accounting identities. Now we need one more definition, and that definition is ROE. It's called return on equity. It is also an accounting concept. It's earnings divided by the book value of equity. What it really is it's a measure of the profitability of the firm. So here's my claim, which I'm going to prove. The claim is that the growth rate of dividends is equal to my profitability, return on equity, times my plowback ratio. By the way, this requires certain assumptions. The assumptions are that ROE is constant and that B is constant. So why is this? What connects growth to profitability? I'm going to prove it. So equity at t plus 1 is equal to equity, this is book equity, at time t plus retained earnings. Retained earnings, keep in mind, are just B times ET. So let's stick this equity into our factory, meaning let's multiply both sides by ROE. So we're going to take ROE times equity at t plus 1, and we're going to take ROE times equity at t plus retained earnings. By the definition of ROE, what we get on the left-hand side is earnings at t plus 1. What we get on the right-hand side is earnings at time t plus B times ROE times earnings at time t. Wow. What we've just shown is that earnings at t plus 1 is equal to earnings at time t times 1 plus B times ROE. This tells us that the growth rate in earnings is equal to B times ROE. Now, wait a second, you may say. Very nice. So the growth rate in earnings is B times ROE. But we didn't want the growth rate in earnings. We wanted the growth rate in dividends. But it's not only the growth rate in earnings, it's the growth rate in dividends. So ET plus 1 is equal to ET times 1 plus B times ROE. So if we multiply both sides of this equation by 1 minus B, we get dividends. Dividends at t plus 1 equals dividends at t times 1 plus B times ROE. You'll remember that G was the growth rate of dividends. So we have just shown that G equals B times ROE. That's the end of our proof. Let's do an example. Let's say ROE is 15%. We invest $100, that's equity at time 1. My plowback is 60%, 0.6. So my earnings at time 1, well, I put my $100 into my machine, which operates at an ROE of 15%. So my earnings, by definition, at time 1 are $15. What are my retained earnings? Well, of those $15, I plow back 60%. So I retain $9. So therefore, my equity at time 2 is my original $100 plus the $9, or $109. I take that $109 and put it back into my factory and get out earnings at time 2 of $16.35. So you'll notice that the growth rate, G, in earnings equals 1635 over 15 minus 1, or 9%. That 9% is equal to B times ROE, 0.6 times 0.15. So how do we use this formula for growth? Well, let's substitute it back in to our constant growth formula. Remember, the price per share of the stock is the dividend per share next year divided by R minus G. Substituting in, well, my dividend is the earnings that I didn't plow back. That's sometimes called the payout. And what's G? G is ROE times B. So now I have a new formula for the price that's in terms of things that are somewhat more primitive: the earnings, the plowback, and the profitability. We also have an equation for the price-earnings ratio, which is often used as a valuation metric. So what happens to a company if there's no investment, if nothing is plowed back? So consider the case of B equals 0, no investment. What happens to the formula? So remember, P0 equals E1, 1 minus B, over R minus B times ROE. B equals 0, we get E1 over R. This is what's known as a cash cow. The cash cow is milked for E1 every year, forever. It never grows. It just pays E1. And so its price is simply the perpetuity with growth equal to 0. If we want some growth, we need some investment, B greater than 0. But not all growth is created equal. Let's look back at this formula. So keep in mind that growth is B over ROE. If you want growth, you need to either increase your profitability or you need to plow back more. But the relation between B and price is complicated. The plowback, which is, remember, reinvestment, is both in the numerator and in the denominator. So you might say, is it always better to grow? Well, there's two different effects. Suppose you decide, hey, let's grow the company by increasing B. What could happen? Well, you might increase price. That could happen because G is higher. But you might also decrease the price because D1 is lower. So there's a trade-off. So which effect wins? What determines whether growth increases the price or not? Well, I hate to say it, but the way we figure this out is by taking the derivative. Not just the derivative, but the partial derivative. I'm not going to go through the algebra. You can see the notes. I'll just tell you what it is. The derivative of the price with respect to B is E1 times ROE minus R over R minus B times ROE squared. Now this denominator here, is always positive. So growth increases the price if and only if profitability exceeds the discount rate. So we know when growth is good. It's when profitability exceeds the discount rate. Let's do an example. The discount rate is 12%. The return on equity is 10%. The plowback is 60%. And the earnings per share next year are expected to be $10. P0 is equal to $10 times 1 minus 0.6. That's my expected dividend next year. In the denominator is R minus G, which is B times ROE, or 0.06. This is $4 over 0.06, or approximately $66.67 per share. Now, this company is what you might call a takeover target. Why? By lowering B, you can raise the stock price. So let's use the same number and set B equal to 0. Then P0 is just my earnings next year. The shareholders get all of the earnings divided by the discount rate. And that's $83.33. I'm going to write it down. This company destroys value by reinvesting its earnings. By growing, this company actually is destroying value. So we don't want that. So to summarize, if ROE is greater than R, P0 increases with B, namely growth is good. If ROE is less than R, P0 decreases with B. If ROE is equal to R, P0 is equal to E1 over R, the cash cow value, regardless of B. So when ROE is bigger than R, cash inside the company is more valuable than cash outside. That's why it's better to grow the company. But when ROE is less than R, cash outside the company is more valuable. It's better just to return the cash to shareholders in the form of dividends. And when ROE equals R, cash inside the company and outside is the same, so it doesn't matter if cash is reinvested or not. That's kind of surprising. This company is a cash cow. It's worth its cash cow value, whether or not the cash is reinvested or not. Now we can connect this concept back to that of NPV. It turns out that when ROE is greater than R, this firm has positive NPV opportunities. When ROE is less than R, the firm has negative NPV opportunities. So I encourage you to look at the optional sections in the notes that connect this formula directly to NPV.